I consider it one of my biggest achievements since now in my lifetime.
I think it went down by like 30 or 40% within like first couple weeks or couple months, and I freaked out. I sold everything, and I'm like, no, this is horrible. This is bad. This doesn't work.
Still better than going bankrupt. But
how did you end up with managing a 7-figure portfolio?
CFA stands for Chartered Financial Analyst. It's a universal worldwide certification. It's highly respected by the financial industry.
Actively managing big portfolios. What was that like?
I was finishing from the office. I was going back home at around 8 o'clock in the afternoon. I was studying till 12 o'clock in the midnight. And then I had half an hour for myself to relax and get ready to go to sleep.
Yeah.
No, I think it's impossible.
Where's the limit? Like when would you normally accept the clients previously in your business?
The minimum amount was around 100,000 euros to start managing a discretionary portfolio. Mm-hmm. For every guy that wins money, someone else loses money.
So first of all, I think for everyone who is watching, big thank you to George for accepting my invitation to torture him about finances for a couple hours on this lovely Friday. So hi, George.
Hi, Melis. Thank you for the invitation. Thank you for having me. And I hope we will have a pleasant discussion for our viewers.
Absolutely. I think we have quite a few topics to cover, and I love that I have a person who actually done most of the things and can talk from practical side, not only from theory. So for all the viewers, we'll be looking to discuss investing, trading strategies for beginner investors, and sort of the themes for what works and what doesn't work really for individuals in finance world. Also, what really happens when the person presses buy button or sell button on stock, bond, ETF, because we have a huge trip of the steps, what happens behind the scenes, and majority of people are not familiar with this. So I think it's going to be a good way to sort of look behind the curtains and review the full process. And our guest today, George, is looking after Athens office for Freedom Finance at the moment and has quite a lot of experience. I'll go through your full experience if you don't mind, and sort of torture you a little bit there to sort of review that side. But also I think the good highlight is that you did actively manage a 7-figure portfolio previously, and you actually have that practical side where you can share, what works, what doesn't work. So I will sort of have challenging questions about, is trading actually worth it for retail investors, for simple investors who don't necessarily have a lot of money and really want to, become millionaires in a week or less. So is that possible and so on? But let's start with, very, very early beginning. Like how did you end up in a finance space? How it all started?
Well, since I remember myself, capital markets intrigued me, stock exchanges intrigued me, watching the television, prices going up and down. I don't know if I chose finance or if finance, industry chose me, but it worked well together. I think it's a very dynamic sector. It's constantly changing. It combines statistics, mathematics with other socio-economic factors like, behavioral finance and psychology and herding and how people react on news and on different inputs. So it's something that I find very interesting. I never get bored of it, and I think I shoot well in this industry. I had the luck to achieve and succeed passing in the university and studying accounting and finance here in Athens. So then it created the momentum, and here I am now working for a very good company in the financial sector and feeling very creative day by day.
Amazing. So do you know, have you ever thought what sort of triggered it? I end up in finance space, even though I have 10 years of experience in logistics, which is super weird. For me, it was more of a it started early, and when I was like 12, 13-year-old, started by playing simple board games about finances, and that was, that's interesting. And then, that sort of took a while for me to move towards that space, and always ran in the background. What was that sort of first move? What caught your attention? Maybe it was like a TV show you saw, maybe a friend, maybe a parents show you something about finance, because it's quite a specific sphere. Not a lot of people think, when I grow up, I'm going to be looking after 7-figure portfolios. That's usually not the case.
Well, it's a bit paradox because no one of my family had a financial background. But I think my first memory of stock exchanges and indexes and things like that was watching the news and discussing with my father about Dow Jones. I remember I was about 10 years old, and Dow Jones was around 6,000 or 7,000 points back then. And every evening, my father asked me, "Where did the Dow Jones close today? Where did the Nasdaq close today? Where did the Greek stock exchange close today?" And these are my first memories that I think hooked me into watching the stock markets and becoming familiar and liking the process of it.
Yeah. Well, and have you ever thought, like, if I would have invested when I was 10-year-old, like, what was it, 7,000, and now it's like 30, 32, 33?
Yeah.
That's like,
I think it would have very, very good results for me.
well, let's talk. When did you actually stepped into the investing world yourself? When did you start investing yourself? And I might want to sort of distinguish investing. So actually putting your money towards working in some sort of asset class. So there is that opportunity investing in yourself, which I think each individual choice makes it that choice earlier or later. But more about like putting your money towards, I don't know, stocks, bonds, ETFs, or other asset classes. When was that first step? And could you share a story? Like, what was it? What was your choice? Be it bad, be it good. Curious to see what started it all.
Sure. My first trades and experiments in the stock market was during university. I was around 20 years old when we were discussing with friends about what are we going to do. Are we going to invest in any stocks or try this industry and allocate some capital to the stock exchange? So we started experimenting with some stocks, with some Greek stocks. My first stock was a Greek bank, which eventually went bankrupt during the crisis. So my first experience was not very pleasant because I don't know if you remember, but we had a very deep and prolonged crisis in Greece around, it kicked off around 2010, and it was present, it's still present in some instances, but we faced a very, very deep recession. So I started around 20 years old. Then when I started working at around 25, I had exposure to foreign markets as well. So I started investing in US and European stocks, and with bigger amounts of money and allocating bigger capital to foreign stocks. Now I hold a portfolio mainly in US ETFs and some US growth stocks, as well as some exposure in emerging markets and the Greek stock exchange. So yeah, it's been like 10 years since I started investing.
It's curious. I have not necessarily such a bad experience, but a very similar experience with my first investment sort of step. I think when I was like 18 or 19, it was very small amount, like looking at it back now, but at that point it looked like a lot of money. And I invested also in individual stocks in one of a retail sort of giant here in Lithuania, and I think it went down by like 30 or 40% within like first couple weeks or a couple months, and I freaked out. I sold everything, and I'm like, no, this is horrible. This is bad. This doesn't work.
Still better. Still better than going bankrupt, but
Yeah,
I
yeah,
saw
yeah.
my money go
Well,
to literally zero.
well, I've done that later with bigger sums, so I'm not sure. Maybe
Okay.
some of the lessons is better to learn earlier than later. So yeah, cool. Can you imagine yourself working in any other business sector instead of finance?
Well, there's one business industry, if we can call it this way, that intrigues me and I like it a lot. And it's the aerospace and airplanes and all this stuff. I have to tell you that back before joining the Athens University of Economics and Business, I tried my luck in the Hellenic Air Force Academy. I
Wow.
was a cadet pilot, yeah, for fighter jets. And this is, what I like besides the financial industry. But I didn't like the military lifestyle, so I dropped out and I started studying in the university. So if we say that I would be somewhere else, I would be in a fighter jet, pretending being Tom
Yeah.
Cruise in Top Gun.
Hey, yeah. Looking the last movie, I think the Google trend will show us that a lot more people actually thinking about that in the next future. Yeah. All right, let's go through a little bit more of specific information. So CFA, could you first of all cover what it is? Like you initially got the CFA certification. Could you talk a little bit more what it is and what it takes to actually go through the process?
Okay, CFA stands for Chartered Financial Analyst. It's a universal worldwide certification. It's highly respected by the financial industry. It covers almost everything that has to do with accounting, finance, and equity valuation and research. I think it's one of the most difficult certifications around. That's why it's highly respected and not a lot of people engaging into getting this certification. You need to pass 3 levels in order to get the certification and the designation next to your name. And yeah, it's something very demanding that I consider it one of my biggest achievements since now in my lifetime, to be honest.
Impressive. Good. So, can you walk me through the process of how can you let's say an individual decided to they want to get their certification to begin with. There's must be some restrictions, like you have to have some experience, you have to have I don't know, either a college degree in similar, or can you go just like go through the course, learn it, and straight away start it?
As far as I remember, you don't need any academic degrees to start the certification. But in order to get the designation, you need to have some experience in the financial industry. It was 3 years. You may pass all the levels, but you're not considered a chartered financial analyst if you don't work for 3 years in the financial industry. If you want to get this certification, you sign up to the CFA, the institution of the CFA. You apply for the certification and you start studying. It's not like a university. You don't attend any classes. It's self-studying material. So you need huge commitment.
Sometimes that's even worse.
Yeah, you need to be very self-disciplined in order to pass this exam. And each year, I mean, back in my days, it was like once or twice per year that you could get the exams. After COVID, it became a bit more digital, so there are more than 1 or 2 study sessions, exam sessions per year. So you have 3 or 4 opportunities to get the exam on a yearly basis. But back in my days, I needed, I spent almost 4 years to complete the certification.
So what pushed you, I assume that you knew that it's not going to be an easy task still, like a minimum of 3 years of commitment to begin with after the university. Once you already have experience of studying in classes with, someone who actually can answer your questions and so on. Now, self-learning, very specific, very challenging topic with quite a lot of material because it's from, all over the industry. Like finance world is quite big. What pushed you to say, you know what, I want that?
First of all, I like challenges, but I have to tell you
Okay.
that it was worse than I expected. Okay, I knew it was difficult, but the reality was very hard when I started it.
Yeah.
Okay, but back in 2015, where I started thinking about what am I gonna do, I had finished my bachelor degree, and I was looking for some additional ways to expand my skill set and improve my academic knowledge around finance. So I was thinking what my choices are. We were going through a deep crisis in Greece, as I told you, so it was a bit difficult to go abroad and study abroad. I was targeting Ivy League colleges in USA because I thought, it was worth it to go and study in an Ivy League college. But it was very difficult to go away. It was very difficult with the capital controls. We had capital controls in Greece. Movement of capital was very hard back then. So I wanted to do something that would be recognizable, highly and universally accepted, and respected by the financial industry. So I ended up with CFA. I was doing it simultaneously with my day job. So it was like having two jobs. I was finishing from the office. I was going back home at around 8 o'clock in the afternoon. I was studying till 12 o'clock in the midnight. And then I had half an hour for myself to relax and get ready to go to sleep.
How old were you
non-stop
at this point?
I was 25 years old, 26 years old when I did it.
You don't need sleep when you're 25, do you?
Well, it had a lot of social consequences, you
Absolutely. No, it's quite a big commitment, and for 3 years,
yeah.
I can sort of, for 3 months, if you're like, pushing really for the next level or something, like, I think quite a lot of people can do it. But if you're like over 1 year and doing it a year after year after year, even with a pandemic challenge, is like, that's tough. Like, absolutely.
And the curriculum, it's not like that you need to be Albert Einstein to understand what it says. It's about the commitment. It's about the commitment.
The discipline
because
of actually putting the work.
The curriculum and the amount that you have to study is so huge that if you start, let's say in September, you forget what you studied in December. So you have to have a very detailed plan. And my study cycle was around 6 months. And during, I started, let's say if the exams were in June, I started studying hardcore studying in January with 3 day offs for all these 6 months. I just had 3 day offs of not studying. I remember myself going, for Easter vacation with my girlfriend or with my friends and waking up 2 hours before the other guys in order to study. So it was hardcore studying.
Yeah, well, that puts you, on a next level for sure. So, what do you think was the most challenging part from all, certification? Was it that discipline requirement, or was it the challenging year where exams got pushed to the next? Do you have like one specific part which was like, surprisingly more challenging than you expected it to be?
Well, it was the last level. It was level 3, as far as I remember. To have the commitment and the combination of commitment with the anxiety of I need to pass the exams, because if I don't, I will do it once again next year. So this was very challenging to keep yourself together and be focused on this and not let anxiety flood your body and your brain. So I thought that the third level would be the easiest one because you have the 2 consecutive, let's say, wins and passes. But it was very difficult because I would not like to do it once again. Study once again in this intense way to get the exams.
Cool. All right. How did you? So you finished when you're in university. You already started to work in finance industry. How did you end up with managing a 7-figure portfolio? Because that's not like something you just walk into. I don't think you can go on a job market and just say, I want to manage a lot of money, thank you very much. You have to go through certain steps. Can you walk me through how did you end up in that position?
So my first job was at a brokerage firm. I started as a salesperson, cold calling and attracting new clientele and new assets to the firm. Then I got promoted to sales trader and retention manager, where I was at the execution desk of the company, executing orders and trades on behalf of clients, and speaking with clients in order, to keep them up with the news of the markets, what's going on, what's the next big thing, and keep them informed in order to help them decide about what to trade and what to do with their portfolios. And I spent 3 years in this company. Then along with 4 of my colleagues, we decided to form our own company. Because we had the clientele that trusted us, we were good at what we were doing, and we decided to form our own company. And we started a partnership with another brokerage firm in Athens, in Greece, as tied agents. So we were managing our own portfolio, and of course, we set up the whole department of foreign markets for this specific company. So if they had a client that wanted to have exposure to USA or other European stock exchanges, we were managing his assets and his portfolio. So that's how I ended up in the asset management industry.
Yeah, amazing story. That's like, starting from like cold calling, ending up with your own business. That's quite a trip there within a couple minutes. All right, let's destroy some myths, because I keep hearing this, and I do discuss with a lot of beginner sort of, I don't want to say investors, but people who want to start investing and start reading some couple things and sort of think that this is easily done. Actively managing this big portfolios. What was that like? Like what your typical day would look like? Could you, walk through that little bit of history behind the scenes?
Okay, first of all, it's not like the movies. I mean, we're not stuck in front of the monitor trading the markets all day long.
I thought you have to have like the more monitors and the bigger monitors you have, the better you do your job.
So it's more or less a standardized practice, a standardized process, let's say. When you are managing assets on behalf of a client, you don't do what you want. On a daily basis, you have specific mandates, you have specific rules that you follow, and they depend on the investment profile of the person that you're managing his portfolio. So the day starts by going through the markets, what's going on, anything around the world that may move the markets substantially. Then you open your terminal, you see how your portfolios performed the previous day, but just for information reasons. I mean, you will not trade actively in this specific date. You have some rebalancing periods where you do the trades and the transaction in order to keep the mandates and the objectives of the portfolio in the specific corridors that you have set. Let's say if you have a 60-40 portfolio, 60% in stocks and 40% in bonds, after 3 months, it will be, because of the price fluctuation, the percentages will be different. Maybe the stock exposure will have been in 65%, and the bonds will have go down to 35%. So you have to, during the rebalancing period, you have to adjust it according to the mandates that you have when managing the portfolio. Besides that, you have the investment committee where you gather with other professionals of the company that you work, and you discuss about the plans for the next 6 months or the next year. If you have to add or reduce exposure to a specific market, if you want to add or reduce exposure to a specific stock or bond. So it's something very standardized. It's not thrilling, and you're not trading the markets on a daily basis or on a short-term time frame. More or less, it's that I described you now.
Mm-hmm. So for people who might not understand the mandates thing, or first time they heard the 60-40% portfolio. So let's say I'm a new person who wants to invest a certain amount of money. Obviously, there's going to be a limitation of of a portfolio which I'm bringing. Like I cannot come in with 100 euros and say manage my portfolio actively.
Mm-hmm.
So let's say I come in with a certain amount of money. Where's the limit? Like when would you normally accept the clients previously in your business?
The minimum amount was around 100,000 euros to start managing a discretionary portfolio. Mm-hmm.
So if I, let's say, walk in and say, let's say we go through all authentication process and I want to work with you, you confirm everything, and actual part where, we go through the strategy, you initially work as an advisor and I confirm the rules, and you don't just go and say, all right, I feel good about this stock today. I'll
No.
I'll buy that for 50,000 and we'll
No,
see
no.
what happens. You follow the rules which are already set up in a guidance, and you
Mm-hmm.
just initially I assume majority of these portfolios are still set up for long-term holdings with some little exceptions, where you want to have very specific exposure to very specific, niche market or niche industry. Would that be correct?
Well, it depends on the strategy of the portfolio. There are some portfolios that are managed more actively than other ones. It depends on the client. It has to do with his investment objectives and his risk profile. So we're going through interviews, through appropriateness tests and suitability tests to end up with your investment profile that suits your investment needs and objectives. And then we decide which portfolio is the optimal for you. Then we go through the strategy that we have set for each portfolio. So it's not like I feel good for Apple, so let's buy Apple. The mandates are very strict and very specific in the transactions and the trades involved when we are talking about asset management and discretionary management of portfolios.
Okay, so let's, on the other hand, take the retail investors, which think that managing an active portfolio is, let's say, actively just trading, looking at the desk, looking at the graphs, trying to predict where the price move will go in a 5-minute, 10-minute, I don't know, by the day period. Do you think, first of all, it's possible to consistently make profits over the long run doing that type of work?
Let's define what we mean in the long run and what we mean consistently. I mean, do you
let's say
for 10
10-year
years, let's
period of
suppose?
time.
No, I think it's impossible. It's impossible even for very, let's say, experienced and very savvy guys in the financial industry. It's almost impossible to beat the markets in the long run. Especially a retail trader who has only one monitor, his brain, a pen and a paper. How is it possible to compete with the high-tech, quantitative, high-frequency companies that trade in the fraction of a second? I mean, it's impossible to compete with these opponents, if we can say that they're opponents in the market, because short-term trading, it's something like a zero-sum game. So for every buyer, there's a seller, and for every guy that wins money, someone else loses money. When we talk, on the short-term trading frames. So I think it's impossible, but of course, someone can make money if he jumps into a trend and for 6 months, 1 year, 2 years, 3 years, it's possible to outperform the market and have substantial and very generous returns, but it's not possible to do it in the long run. If you have a long-term horizon, it's 99% impossible to beat the market. I mean, who has done it? it's a handful of people that everyone around the globe knows about them, like Warren Buffett, like Jim Simons, and guys like this. I mean, it's a bit it's a bit weird to compare ourselves and a retail trader to these guys.
Yeah, and even they normally don't look at the, investing for, making profits in a day or even in a week. They normally buy the quality businesses, and the information access they get is just ridiculous compared to, the information
Of
we
course.
have. So yeah, I completely agree on you, but it's sometimes good to, get that confirmation from someone who's already been in a game and seen it instead of me. So, yeah. When you say someone loses, like on that short term, could you elaborate on this one a little bit? Because I do believe that a lot of people think that when they buy from, the business. They don't buy from a different investor. So if we go through the process just on that specific order, when you say someone buys and someone sells, so immediately that's a confirmation that one of the parties will lose, correct?
You mean the zero sum part that I
Yeah.
described previously? No. Well, when we are speaking about investing in equities in the long term, I don't consider it's debatable, and it's debatable between professionals in the market. But I'm on the side that I don't believe that it's a zero sum game when investing in companies for the long run, because it's not 50-50, 50% long and 50% short. It's not like that. So we have money creation in an accounting perspective, which then, if you liquidate your position, becomes real money. So I think that investing in equities is not a zero-sum game, but investing in trading and investing into derivative products like options and futures, it is a zero-sum game, and that's a reality, because someone makes the market for the derivative that you buy. Either is it a future or it is an option. So someone's profit is someone else's loss. It's a zero-sum game because there's an issuer and the market maker between these specific products that allows you to trade in a shorter term period. But it's not the thing with equities, because there is an entity that makes products, sells products, has cash flows, has net income that it mirrors the performance of the company in the equity price, in the price of the stock.
I think I would agree, because at the same time, if you adding the long term part, you adding the different objectives. If I'm a retired person, my objectives is not capital gain. My objective is initially, producing certain amount of income for my life expenses, and selling is a strategy which helps. But yeah, for that short term where you're initially, trying to act basically on price fluctuations, at that level, each order has a person or a party who won and a party who initially lost. That's correct, yeah?
Yeah.
Okay. Let's jump into the simple question of what do you think is the best strategy for retail investors, so for beginning investors. Sometimes they don't like the word retail. Even I consider myself a retail investor. Like I'm a considerably small investor compared to the other guys there. So what do you think is the best strategy for someone who, let's say, don't have a lot of time to spend in the stock market, don't have a lot of knowledge to actually, compare the items, compare the ideas, compare the strategies, but do want to put certain amount of money towards their future, towards the stability, towards the, I don't know, be it a pension, be it a potentially house, initial payment, or any other sort of expenses in the future, but looking like 10 years plus?
Mhm, mhm. First of all, I need to say that we're very lucky to live during a period that we have so many options and choices in our investing journey. I mean, we're very lucky that we're downloading an app and we open an account almost immediately in like 5 or 10 minutes, and we're able to buy any asset in the world, from Japan to the USA. So we have access to a lot of products for a beginner investor and a non-professional investor that does not want to invest a lot of his time and consume a lot of his time during the day to watch after his investments. I think that a broad index ETF is the optimal solution. Choose the sector, the market, or the country that you believe it's going to be prosperous in the next 10 years. Buy this ETF. It's a very liquid product. You can sell it, you can buy it again whenever you want, and let the time do the job. You don't have to do anything else. You just have your money invested in something that follows a broad market. It's very liquid. It's very safe. It has minimal costs. It does not consume a lot of your time, and you can achieve your investment objectives if everything goes well from a macroeconomic perspective. You can achieve a lot of your investment objectives. So,
Amazing.
an ETF would be an optimal solution.
So on comparison, majority of the times when I share where I put my money, like where should new investors put their money, the main question I get is where do you put your money? So George, where do you mainly invest? You mentioned that current, like you started with one strategy, you now are going with completely different strategy. Could you share where majority of your sort of investments go, sort of week by week? Month-on-month basis, year-over-year basis? I assume you don't change your strategy that often.
No, I mean, I started building my core portfolio, let's say, my long-term portfolio, like 4 years ago, 5 years ago, with a specific strategy, which I still abide to. I have a core satellite approach. Almost 50% of my assets are in the broad index ETF of US indexes. Triple Q that follows Nasdaq, and SPY that follows S&P 500. And then I have some exposure in emerging markets, Chinese technological ETF, like KWEB, if you know. I have exposure in the Greek stock market via an ETF as well. And of course, I have some exposure in single stocks. I try to not, let's say, analyze so much the stock, but find an industry that I think it will perform good in the future and maybe outperform the broader market. And then I choose the leaders of this industry. At the moment, I invest in cybersecurity stocks, fintech stocks, and e-commerce stocks. I think that I have 8 stocks in my
Worldwide
portfolio.
or US based?
Worldwide, I have stocks from Singapore, from Germany, from USA, and from China.
Okay. So what are your satellites? If your core portfolio are mainly ETFs and I would say blue chips in a way, where your satellites are, or those satellites are the individual companies?
Yeah, I consider core my exposure in S&P 500 and Nasdaq, and all the others I consider them satellites.
Okay. Understood. All right, let's jump into a little bit technical side. I think that's the part which I'm intrigued to understand. You currently work in Freedom Finance, look after the Greek Athens office. I use it one of my main brokers in general, and I think we can use them as an example, purely to understand the technical side of what happens step by step after a person presses buy button or sell button. So I'm assuming that majority of the brokers will have very similar structure from a certain point as you go through the prime brokers and so on and so on. But can you go through the process of, let's say I'm a client of Freedom24 broker. I go on my app, I click buy on, let's say, Apple stock on a Monday on a market open hours, market active order, and immediately within like second, or depending on my phone how quickly it reacts, it says, I have an Apple stock. So at what point Apple understands that I'm a shareholder, because that takes quite a while and the information goes through quite a few steps. Could you walk a little bit through the step of, me pressing the button, what actually happens through the system, how quickly that goes through, all those little details behind the scenes?
Okay, so let's name all this process as the trade life cycle, right? So
Perfect.
the trade life cycle consists of three different parts. Let's start with the trade. It's what you said. When I push the button and I see the Apple stock registered in my portfolio on the Freedom24 app, for example. This is the initial act of the life cycle of the trade, is where I agree, I shake hands with the seller that I will buy the stock in the price that we agreed. Let's assume that it's $100. This means that I'm obligated to pay him $100 in exchange for an Apple stock. But this is just the tip of the iceberg. It seems like I have the stock in my portfolio, but in the back end, there are a lot of processes that have to run, involving a lot of counterparties, a lot of financial institutions, which exchange information, from the USA to Europe to Japan, or every market that is involved in every financial institution. It depends where it's of the investors' seat. So the second part of the trade, it's called clearing. Clearing actually is removing the risk of not paying the seller the amount that I must pay him, or the buyer not receiving the stock that he's about to receive. In our example,
if we try to name the buyer, the seller, could you just let's say put me as a person who's buying, who's the seller here? Just to
let's assume
make
that
it
I
as
am the
simple as
seller.
possible.
Okay, yeah. Let's assume that you are a buyer. You use Freedom24 stock. You use Freedom24 broker for executing trades. And let's assume that I am the seller and I use Ameritrade as a broker, and I am in the USA.
Yeah.
I am about to sell the stock and you're about to buy the stock. The transaction is executed on an exchange. But how does the exchange know if I have the stock in my portfolio, as I said? And how does the exchange know if you have the money that you said that you have in order to buy this stock from me? This is where the clearing begins, and we have huge financial institutions, which are called central counterparties, which act as a mediator, act as a counterparty to every transaction performed on the stock exchanges. These financial institutions guarantee that you will receive the stock and I will receive my money. In order to do that, the brokers and the financial institutions that are members of the exchanges or perform transactions on the exchanges put some money as collateral. Let's say central counterparties need around 10 or 20% of the amount of the trade in order to take the risk and clear the risk of the transaction. In our example, they will need a deposit of approximately 10 USD from the broker in order to take the transaction and clear it. So they're actually removing the danger, the risk, the counterparty risk of not having money or assets to deliver. And this is very crucial for the stability of the financial institutions and the stability of the stock exchanges. And in every exchange that the central counterparty acts as a mediator between the transactions, there are no failed trades. I think that since 2008, we have not any failed trades in a big in a big amount. I mean, between any counterparties involved in transaction in the stock exchange. So this is the second part, and it happens after the closing of the stock exchange. After the closing bell, Each broker delivers the reports with the transactions that need to be cleared and settled eventually. The third part is the settlement procedure. The settlement process is the final act of the trade life cycle, which actually goes to the depositary. Depositary, it's like a vault where all the assets are held on behalf of clients, brokers, and other financial institutions. So in order for you to buy the stock and register it under your name, the stock exchange must reach my depositary, take this stock, move it to your depositary, register it under your name, and then you're considered a shareholder of Apple. On the other side, the money should be delivered in my account, and I have cash to do whatever I want with this. So this is more or less the trade life cycle. I try to keep it as simple as possible, but it's very interesting.
Yeah.
It can take almost 2 days in order for all these processes to complete after the trade date. The trade date is when you push the button.
Yeah.
So if we assume that you buy the Apple stock today, which is Friday 24th of February, the transaction may be settled on Tuesday 28th. I think it's because it's 2 working days that may last for all this process.
Yeah, I'm just trying to think of. So before that end of the market, I'm assuming each broker has also multiple ways to assure that, let's say I'm a client and I'm trying to buy Apple stock and I don't have enough cash. That's immediate market reject, or you're not even able to, submit your order purely because you don't have enough money. So all of those procedures, all of the little tasks across the sort of steps also exist. Now, how does that work? That on my screen, I immediately have Apple stock.
Yeah, I mean, the client is not involved.
In your example,
in this.
You also have the money. So would you say that's just a sort of a promise of asset, like guarantee from the financial institution?
Actually, it's the job of the brokers, of the stock exchanges, of the depositaries and the clearing houses, to facilitate this process. And not, back in the old days, in the stock exchanges, they were exchanging papers and stocks were in papers with money. So, the digitization
type of thing.
The digitization of the industry actually allows the client to enjoy this instant execution and this instant exchange of money and assets, and lets the brokers and all the other financial institutions do the job in the back end. So actually, the risk is for 2 days for its client, for 2 days till its trade is settled. But as I told you before, in the last 20 years, we have not any material issues happened around the world about a trade not being performed, not cleared, or not settled. Everything works like a clockwork machine. There's a lot of experience in this financial institution performing these transactions. They're heavily regulated, which is very important in order to protect the retail customer and the retail investor. So it's something that it's very complicated, but this is the job that brokers do. This is the job that regulators do in order to facilitate clients to execute their orders in a prominent and easy way.
Yeah, I managed to get into this theme. Well, I sort of fell in love with dividend investing at some point. And for me, understanding what T-2, those 2 days, or T-1, depending on a broker, was crucial to understand when do I need to buy before the ex-dividend date. Because if you buy too close to that time, you might be okay, or you might not be okay, and you might miss the dividend payment altogether. Well, of course, it's normally in the long run, you're not necessarily, benefiting only from that one specific time. But I just simply learned that from the scenario where I bought it like a day before the ex-dividend date. And I later understood that the broker process takes about 2 days, and then I was actually late for that process altogether. And I was like, what is this on? And then it's like T-1, T-2. Now you're talking. So yeah, that's got my attention quite good. But I think I agree with you with the point where, this is the job from a broker, from financial institutions, from regulators. Majority of retailers and investors should just be aware that T-2 actually exists, that, you do need to be aware that the full process can take up to 2 working days for your stocks or for your assets to actually be completely yours, for all the validation, moving and so on and so on. But if you're looking for, I don't know, let's cover that example of, just buying ETF for the long run, you're not bothered. You just,
Of course,
each month, first day of a month, click the buy button. Whenever market opens, that will execute. Thank you. See you next month.
It's not something that should make you worry, let's say. Okay, if you were an institutional investor, investing billions and worrying about the clearing and the settlement of the order, then yes, you have to monitor it very closely. But in our instance, where we invest small amounts of money, it's not something that we should worry about.
Yeah. All right, let's move to, you already mentioned some of them, options, calls, futures. Do you think in general it's sensible for a beginner investor to look at these options?
Well, from my personal view, I mean, I love options. I love futures. I love the way that they are engineered and the way their pricing works. Imagine that Black-Scholes and Merton, who invented a formula for option pricing, won a Nobel Prize in economics. So you can understand the complexity and how important the mathematical part of derivatives is. I really admire options and enjoy trading options. I have a small trading account where I do such trades. But I think for a retail beginner investor, in order to invest in such products, he has to do a lot of reading, a lot of self-studying, in order to understand how these instruments work. Of course, you can speculate in the short term. I don't think that I can win the market or outperform the market by options trading, but it's a very nice tool. And of course, if we see it from the hedging part, if you want to insure your portfolio in specific time frames, if you're afraid of the markets, you can use such tools to protect your assets from sharp movements. So from this perspective, it can be useful, but from the speculation perspective, someone must be very, very cautious on how he trades such instruments and how they perform and how they operate.
So you sort of see it as a potential insurance if you're looking at the market and you're predicting the, I don't know, huge downfall or some of the news which could potentially impact the. But for the type of, I've seen some news and I think it would be good to act on them through options and, speculate and try to win more than maybe someone should. I try to avoid the word recommended, but not necessarily a good choice.
Sure. Yeah. I mean, you have to be experienced enough to speculate based on market news. I mean, more or less, they are binary events. Either the stock goes up, either the stock goes down. So if you want to protect your assets from a sharp downwards move, you may lose the sharp upwards move. That's the cost of the insurance. So it's a bit tricky. I recommend it for experienced investor with larger portfolios that they might have material impact in their strategy or in their daily, let's say, cash flows or their fixed income if they use their portfolios for such reasons.
Perfect. One more topic, the margin. Do you think it's a good idea to use margin when you invest? And do you look at it more as an opportunity or more as a risk?
Yeah, well, from the perspective again of a beginner investor, I would not recommend it. Um, I think it's a high risk strategy. You need to be very cautious. Uh, I don't think that will work for a beginner investor. It's for certain periods, just to take advantage of momentum or of a sharp move, or for hedging reasons maybe. But that's all. I mean, if you want to trade on margin, you better know what you do. If you're not experienced with such transactions, don't get bothered with trading on margin. It's very expensive as well. I mean, because as I told you, I have a trading account that I invest on margin with futures, with options. I look the costs at the end of the year, and they are really huge and tremendous. I mean, you don't understand it on a daily basis. If you see it at the end of the year, the amounts could be substantial, and the costs are big. So for a beginner investor, better don't do it.
Yeah, I suppose you need a significant portfolio to actually utilize it, and it's one way to burn your portfolio very, very quickly.
Yeah,
One of the
of
most
course. I
effective ways to, if you want to just destroy it.
We see it almost in a daily basis here. Clients that try to trade with margin, they suddenly find their portfolio near to zero and say, "What's going on? What happened? Why my portfolio? Why I lost all my money? Why is my portfolio near to zero?" And then we explain how margin works, because they don't know, and they're experimenting with things that are literally dangerous for their financial assets. So yeah, you better know what you do. Make a huge due diligence and research before start investing with a margin or with instruments involving margin, like options or futures. And if you feel comfortable about it, go for it. Try it, but you need to be a bit more experienced.
Cool. All right. This is the end.